Gold is breaking records, again, but this time, it's different. Experts are now warning that we could be on the verge of the biggest gold bull run in history. The last time gold surged like this, it jumped over 500% in just a few years. And right now, major banks and institutional investors are making massive moves into gold, signaling that something big is coming. If gold is heading to $4,000 per ounce, the real question is, are you positioned to take advantage of it or will you be left behind? Gold prices have already shattered records, surging past $2,500 per ounce, and the momentum is only growing. Inflation is still out of control, with the U.S. inflation rate now sitting at 5.2% in early 2025, pushing everyday costs higher at an alarming rate. Meanwhile, central banks and hedge funds are hoarding gold at levels we haven't seen in decades. All the signs point to one thing: gold is setting up for a historic breakout. Welcome to Golden Years Capital, where we break down complex financial topics so you can make smarter investment decisions. By the end of this video, you'll understand exactly why gold prices are skyrocketing, what's fueling this explosive rally, and whether we could see gold hit $4,000 per ounce before the end of the year. Gold is already moving higher, but institutional investors aren't waiting. They're making massive moves now. BlackRock, the world's largest asset manager, just increased its gold exposure, citing long-term concerns over debt sustainability and economic volatility. Meanwhile, gold-backed ETFs have seen over $20 billion in inflows in just the first quarter of 2025 alone. This isn't speculation. This is a clear sign that the biggest players in finance are positioning themselves for what's coming. According to Rick Rule, a legendary investor and former president of Sprott U.S. Holdings, the setup for gold today is even stronger than it was in the 1970s. We have higher debt, greater economic uncertainty, and an increasing loss of confidence in central banks. If gold follows its historical trajectory, we could see prices go much, much higher. Bank of America recently raised its gold price target to $3,500 per ounce, citing growing recession risks and a potential stock market correction. If those predictions are correct, gold still has massive upside potential from today's levels. But let's talk about what's driving this massive surge in demand. One of the biggest catalysts for higher gold prices is government debt. As of early 2025, U.S. national debt has soared past $35 trillion, with interest payments now exceeding $1 trillion annually. This debt crisis is spiraling out of control, forcing policymakers to consider extreme measures, many of which could be disastrous for investors relying solely on traditional assets like stocks and bonds. When government debt reaches these unsustainable levels, it erodes confidence in fiat currencies, making gold even more attractive as a safe haven asset. But there's another key reason gold is set to rise: the declining U.S. dollar. Over the last 2 years, the Federal Reserve has struggled to balance interest rates and inflation. Despite multiple rate hikes, the dollar continues to lose purchasing power. Historically, when the dollar weakens, gold prices rise, and with the current state of economic uncertainty, gold could be gearing up for an explosive rally. Let's put this into perspective. During the 1970s, when inflation spiraled out of control and the stock market struggled, gold surged by over 500% in just a few years. During the 2008 financial crisis, gold jumped over 150% as investors rushed for safety. More recently, during the COVID-19 crash in 2020, gold soared past $2,000 an ounce for the first time ever. Each time the economy faced turmoil, gold emerged stronger than before. If history repeats itself, and all signs suggest it will, we could be in the early stages of a major gold bull run. But what makes this gold rally different from past cycles is the sheer scale of global economic instability combined with unprecedented monetary policies. In 2008, the Federal Reserve launched its first major round of quantitative easing, injecting trillions into the economy. But that was a one-time emergency measure. Now, money printing has become the default response to every crisis. In the last 5 years alone, the U.S. government has added over $10 trillion to its national debt, while the Federal Reserve's balance sheet has ballooned to over $9 trillion. This kind of monetary expansion is unsustainable, and history shows that when fiat currencies are debased, gold is the ultimate hedge. During the Weimar Republic's hyperinflation in the 1920s, gold preserved wealth while paper currency became worthless. In more recent times, Argentina's peso has collapsed under the weight of inflation, and citizens who held gold avoided total financial ruin. And it's not just inflation that's a concern. The bond market, often referred to as the backbone of the global financial system, is flashing major warning signs. The yield curve, which measures the difference between short-term and long-term interest rates, has been inverted for nearly a year. Historically, this has been one of the most reliable predictors of a recession, preceding every major downturn in the last 50 years. Meanwhile, the U.S. Treasury is issuing record amounts of debt to cover its massive deficits, but demand for these bonds is waning. Foreign governments, including China and Japan, once major buyers of U.S. debt, have been reducing their holdings, a sign that confidence in the dollar is weakening. If confidence continues to erode, we could see a full-scale flight to gold as investors seek stability outside the traditional financial system. The stock market is also flashing red flags. While indexes like the S&P 500 have shown resilience, much of the recent growth has been driven by just a handful of tech stocks. Beneath the surface, a large percentage of stocks are either stagnant or in decline. Earnings growth is slowing, corporate debt levels are at record highs, and consumer confidence is plummeting. The Conference Board's Consumer Confidence Index dropped sharply in early 2025, signaling that households are tightening their wallets. This is critical because consumer spending accounts for nearly 70% of U.S. GDP. If spending contracts, corporate revenues will take a hit, and stock prices will follow. In contrast, gold's performance isn't tied to corporate earnings. It's driven by macroeconomic conditions and investor sentiment, both of which strongly favor higher prices. With all of these factors converging, rising inflation, a weakening dollar, a struggling bond market, and looming recession risks, the stage is set for gold to surge. Investors who recognize these warning signs early have a unique opportunity to position themselves ahead of the curve. The question isn't just whether gold will rise, it's how high it will go. With projections ranging from $3,500 to $5,000 per ounce, the window to buy before the mainstream rush is closing fast. And there's another critical factor at play: geopolitical uncertainty. Tensions between global superpowers are rising, with trade disputes, economic sanctions, and shifting alliances creating a volatile international landscape. The ongoing U.S.-China decoupling is disrupting global supply chains, while conflicts in the Middle East and Eastern Europe are further destabilizing financial markets. Historically, gold has thrived in times of geopolitical stress. When Russia invaded Ukraine in 2022, gold prices spiked as investors sought safety. If tensions escalate in 2025, we could see a repeat of this pattern, with gold acting as the preferred hedge against uncertainty. Central banks seem to be preparing for this. They purchased over 1,200 tons of gold in 2024 alone, the highest annual total in history. This signals a major shift in monetary policy as governments around the world are actively reducing reliance on the US dollar and increasing their reserves in gold. The message is clear: gold is being revalued as the ultimate safe haven asset. Investors who wait too long risk being left behind as institutions and governments drive prices higher. The smart money is already moving, are you? And here's where things get really urgent. As gold prices rise, demand skyrockets, but supply can't keep up. Unlike paper assets that can be created out of thin air, gold is a finite resource. Mining output has remained relatively flat, and with central banks, institutional investors, and everyday people all rushing into gold at the same time, the window of opportunity is closing fast. Once gold breaks past $3,000, FOMO will kick in, driving prices even higher. And by then, it may be too late to buy in at an affordable level. So what does this mean for your portfolio? If you're relying solely on stocks and bonds, you could be walking straight into a financial disaster. A well-diversified portfolio should always include physical gold, particularly in times like these. The best way to do this? A gold IRA. Unlike traditional retirement accounts that are 100% exposed to market fluctuations, a gold IRA allows you to hold physical gold in a tax-advantaged account, a move that provides both diversification and protection. This is why I highly recommend taking the next step now. Click the link in the description to claim your free gold IRA guide and learn how to protect your savings before gold prices explode. Every day that passes, the risk grows, and so do the prices. Protect your retirement while you still can.